Great. Thanks, Wendy. And I neglected to add a little bit in my bio that I was raised in Chicago. I always like to say that, go Bears, Cubs, White Sox, Blackhawks, Bulls, and so forth. And also that my grandsons are 17 and 19, so you can kind of tell where I am in my career. I think my career is over. I like to say it's now pretty much a vocation. It's really a calling to make a difference. I appreciate that I have IT people listening to this presentation, but you may want to, when you can, I think you'll be able to get the PDF slides, share this with maybe some of the people in your accounting department and CFO position, because they're the ones that really need to support the implementation of the methods that I'm going to be describing today. So let me see if we can advance. Whoop, wrong direction. And now I can go with the space bar. So who will benefit from this presentation? Managers who have previously struggled at promoting rolling financial forecasts as an advance to the annual budgeting process. Managers who intend to champion driver-based budgeting and rolling financial forecasts, and they need a compelling call to action. And the reason I have champion in quotation marks has been my observation over my career that although it's nice to have senior executive sponsorship for new and progressive methods, often they are preoccupied with firefighting or short-term priorities. And it's typically managers that are 1, 2, 3 levels down from the C-suite above them who kind of have passion or fire in the belly and, ask how long do we want our organization to perpetuate using some of these stale or arcane methods? And they're the ones who will basically do a proof of concept or a pilot or a rapid prototyping, which I'll describe an example. And so I really like to really present to lower level managers who will actually try to influence the rest of their organization. I like to begin my presentations with these 3 questions. What, so what, then what? So imagine that when you hear some of the methods I'm going to describe in the presentation, you actually implement them, things like activity-based costing when it's applicable. I say celebrate for 1 day, you're not done. You will see a lot more information that you've never seen before. There'll be so much, the question is what's relevant, so what? But arguably the most important question is the third one, then what? Because all decisions only impact the future. And so this is where we get into things like what if scenario analysis, make versus buy decisions, and the topic here, rolling financial forecasts. It's that future view. So my agenda is I'm first going to have to walk you through some basics on management accounting. Remember, I'm an industrial engineer, but I like to say I'm an industrial engineer masquerading as an accountant, because I've been in the accounting field since the very beginning. I was this division controller in Milwaukee, I think age 26, and I haven't left that field. Then we'll get into what is broken with the annual budgeting process. And then after we understand what the pains are of the existing deficient methods, we'll then move towards, well, how do we then basically move towards rolling financial forecasts? We're going to have to put our industrial engineering hat on because we do need to deal with resource capacity planning. That's classifying the behavior of resources, sunk, fixed, step fixed, and variable. I know you're going to have to become kind of a microeconomic expert. And then at the very end, a frustration that I have, why is it taking so long for CFOs and organizations to implement these methods? So let's get going. I think this cartoon sets the stage for my entire talk. Drowning in data, but starving for information. You've got this poor beleaguered clerk, shoulders hunched, sad, paper all around him, and the supervisor in the left in the doorway is asking him, it looks like you've got all the data. What is the holdup? I gave you the request this morning, why don't you have the answer? And we got to talk about converting data into information. To set the stage of this talk, this is a diagram. I know this is complex or dense, but I'll walk you through it. That I created for an organization called the International Federation of Accountants. They're out of New York City, about 50 employees. They are the professional organization. Their members are accounting institutes globally, like 180 of them, like the United Nations. In the U.S., that would be the AICPA or the Institute of Management Accountants, which incidentally I have a role with them called the Executive in Residence. Actually, I retired after my 3-year term last year. So what it is it's like a taxonomy for like in biology, plant kingdoms, animal kingdoms. So the 3 kingdoms are tax accounting, financial accounting, external financial accounting, and then internal managerial accounting. Now you'll notice the large umbrella at the top, all accounting data comes in from source capture of transactions like from payroll or purchasing or revenues and the like, and some non-financial data, quantities, that are used for metrics. For the external financial reporting, all costs are calculated. Expenses and costs are not the same thing. Expenses are when an organization exchanges money with third parties, like pay suppliers or employees, and all costs are calculated. Expenses, currency exits the treasury. So we calculate the costs. Now, when we go to the left, then we have to follow GAAP, generally accepted accounting principles. That's the GAAP rules set like in the United States by the Securities and Exchange Commission. But for management accounting, we don't have to follow those rules. That's basically more modeling, and I'll describe that in a little bit. The historical view was, things like profitability reporting, which I believe are some of the other webinars I've done for CAI. But to the right, you see the decision support and cost planning. That's the future view. Oftentimes when I present for CPAs, they don't particularly like me because at the bottom I've got the continuum of how much value adding it is, and at the left it's low value add, and that's what most of them do, external reports for the board of directors. Then comes the modest value add, which is historical information, and the high value add is the predictive view we'll be talking about today. So this is my 6 eras of management accounting. It's meant to be a little bit humorous. The first era is, 20,000 years ago with, cavemen and cavewomen. Somehow they may have, done some sort of value exchange with rocks and stone piles. Then in 1496, there was a monk in Venice, Italy, named Luca Pacioli, who basically wrote a book that was described double entry bookkeeping. So that was the beginning of, debits and credits. Now, then we move to the industrial era, kind of a favorite era for me, particularly for industrial engineers. Frederick Winslow Taylor was, sort of the author of, scientific manufacturing, working, for like Henry Ford and, Model T and Model A plants in Detroit. But what many don't know is he had a sidekick, Alexander Hamilton Church, and he created standard cost accounting, which paralleled the manufacturing methods. Then comes sort of a setback, the Depression in the United States. And the reason I call it a setback is because, and I don't fully understand my history here, but some of the causes for the Depression is that the accountants were basically playing loosey-goosey games with whether they would capitalize or expense some item, and that's when the SEC came in with rules. And the reason I call it a setback is it created much more emphasis on external reporting, and that reduced the emphasis on management accounting, and it's imbalanced, and that balance needs to basically be shifted back because external reporting is about valuation, inventory values and the like. Management accounting is creating value through better decisions. Then we move up to basically the historical reporting of not just product costing and good, accurate product costing using activity-based costing. We'll talk about the deficiencies of traditional standard costing, but going below the product gross profit margin line to include expenses of, marketing, selling, customer service, distribution, and so forth, actually creating a profit and loss statement by each customer. This is really important because the large customers are not automatically the most profitable ones because they can be high demanding. And then we get to the highest level, which is our presentation today, predictive accounting, this future view, that then what question. So a little more primer here. Ideally, all costs should be directly charged, but as variety, complexity, and technology increases, what happens is more and more of the expense of an organization becomes indirect because as you increase the variety and types of products, more colors, more sizes, more ranges, the indirect expenses start displacing the direct expenses. So direct costing is really the ideal. The highest form of direct costing at the left is project accounting, and that's typically, for like a make to order, one of a kind, building a satellite, building a construction building. Most organizations have repetitive processes, and that's where they use standard costing. Typically for standard costing, you have some sort of labor reporting of what the employees are doing on work, and then routings and bill of materials for manufacturers. However, I don't want to misguide you. 2 out of 10